Hello everyone, my name is Simo and welcome back to Investment Research. So today, market value is $26.70 and after an incredible run through the year, with the stock up nearly 70% year to date and more than 230% over the last 12 months, the market finally took a bit of a pause. SoFi closed around $26.70, down roughly $2.05 or about 7% for the day. Now that sounds like a big move, but in my view this is simply a normal and healthy correction after such an explosive run. When a stock climbs this fast, it's perfectly natural for it to take a breather. Markets never move in a straight line, and this kind of pullback actually helps reset investor expectations. So what's really going on here? From my analysis, this drop looks more like profit taking than panic selling. Many traders and investors have been holding SoFi since the early part of the year, and with earnings just around the corner on October 28th, it makes sense that some of them are locking in profits. The stock has delivered exceptional gains, so it's completely rational to see a short-term correction before a major report. Another factor at play is what I call pre-earnings anxiety. SoFi has been a momentum story for months now, but expectations have become very high. The company trades around 47 times forward earnings and roughly 9 times sales, which is quite rich compared to traditional banks or even some of its fintech peers. That means the company needs to deliver flawless numbers to justify that valuation. When expectations are that high, even the smallest hint of slower growth or softer guidance can spark a quick reaction in the stock. We also have to keep in mind that some large institutions have been voicing caution recently. Morgan Stanley, for example, keeps its underweight rating with an $18 target. Their analysts argue that there's little margin for error at these levels, and that sentiment could shift if growth moderates. And while I personally think SoFi's fundamentals are much stronger than they were a year ago, I can understand why investors might be nervous before earnings when those warnings start circulating again. There's also the broader market tone. Over the past week, we've seen treasury yields rise, which often pressures high growth names like SoFi. When yields go up, future profits get discounted more heavily, and that tends to make investors rotate out of growth and into value or income stocks. SoFi gets caught up in that rotation because it's still seen as a long-term growth story rather than a stable dividend payer. So if we put all this together, today's 7% decline looks more like a technical pullback within an ongoing uptrend rather than a reversal. The stock remains well above key support levels near $25, and momentum indicators still suggest strong underlying buying interest. In simple terms, this move is a correction, not a collapse. It's the market digesting gains, cooling off some of the speculative excitement, and preparing for the next big catalyst, which is the earnings report on October 28th. Now, let's talk a little about fundamentals, because that's where SoFi continues to shine. The company has built a strong and growing ecosystem that keeps customers within its platform. Over the last few quarters, we've seen impressive growth in member counts, deposit inflows, and product adoption. SoFi's lending business remains a key driver of revenue, but what's really encouraging is how diversified its income streams have become. The expansion into checking, savings, credit cards, and brokerage services has made SoFi less dependent on any single product line. Profitability has also been improving. For a long time, SoFi was criticized for operating at a loss, but that narrative has changed. The company recently posted positive net income and showed significant improvement in net interest margins. Those are real signs of maturity. It's moving from being a high burn growth company to one that can actually generate sustainable earnings. That transition is something markets tend to reward in the long run. However, we can't ignore valuation risk. At current levels, SoFi trades at a premium, and that premium needs to be backed by consistent execution. That's why this upcoming earnings report is so critical. Investors want to see continued growth in both personal loans and deposit expansion, but they'll also be watching margins very closely. The management commentary from Anthony Noto will probably play a huge role in shaping sentiment. His tone and confidence level during the call can either reinforce investor trust or spark renewed caution. Let's not forget that institutional ownership in SoFi has grown significantly this year. That's been a tailwind, but it also means the stock reacts more strongly to big buy or sell orders from funds. Institutional money can move the price sharply in both directions, especially around earnings time. That's why volatility often spikes in the days leading up to results. Now, here's my personal take. I think SoFi's long-term story remains compelling. The company has a clear strategy, strong leadership, and a product suite that appeals to a younger generation of financially active users. It's building brand loyalty in an industry that used to be dominated by legacy banks. In that sense, SoFi is doing something that's genuinely transformative. That said, short-term investors should brace for swings. When you have a company trading at these kinds of multiples, even a small guidance revision can create a 5 to 10% move overnight. But for long-term investors, these pullbacks can actually create opportunities to build or add to positions at more reasonable prices. Today's correction doesn't change the bigger picture. In fact, it might make the setup even more interesting. The $25 range is acting as a strong support zone, and if the company delivers on its upcoming earnings, we could easily see momentum return quickly. The key will be showing that growth is still accelerating and that SoFi is managing costs effectively as it scales. Another thing worth mentioning is that SoFi's fundamentals are improving alongside a broader shift in consumer finance. As digital banking adoption continues to rise and traditional banks struggle to innovate, SoFi's all-in-one approach is becoming more attractive. Its app ecosystem gives users a seamless experience that few competitors can match, and that's exactly what's keeping customers engaged. Now, from a technical perspective, today's sell-off looks like a standard short-term retracement rather than a reversal. The relative strength index has cooled off from overbought levels, which is healthy. Volume on the decline wasn't excessive, suggesting that this move was more about routine profit taking than panic selling. I would actually be more concerned if we saw heavy volume breakdowns below 24 or 23, but we're nowhere near that point yet. In my opinion, this correction was needed. It's the market's way of resetting expectations ahead of earnings. It removes some of the speculative froth and gives serious investors a chance to evaluate fundamentals rather than chasing momentum. So if you've been watching SoFi from the sidelines, this could be a moment to pay close attention. Looking ahead, the story for SoFi will come down to three things. The first is execution. Can management keep delivering consistent growth and profitability quarter after quarter? The second is confidence. How well can Anthony Noto communicate the company's vision in a way that reassures both institutional and retail investors? And the third is the macro backdrop. If rates remain elevated or recession concerns resurface, growth stocks like SoFi could remain volatile. But when I look at the bigger picture, SoFi continues to position itself as one of the most promising fintech companies in the market. It has the technology, the brand, and the momentum to keep expanding. Short-term corrections don't change that story. If anything, they create better entry points for long-term investors who believe in the company's vision. So to wrap it up, today's 7% decline is not a sign of weakness. It's a correction, a healthy pause in a strong uptrend. After a 200% rally in 1 year, this kind of movement is natural. What matters now is the next step, and that will come when SoFi reports earnings on October 28th. That's when we'll see whether this company can continue to justify its valuation and keep rewarding its investors. I'm Simo from Investment Research. I'll be covering those earnings in detail as soon as they drop, breaking down the numbers, the outlook, and the market reaction. Stay tuned for that update, and remember that short-term volatility often hides long-term opportunity. Thanks for watching, and I'll see you in the next report.